Hello, everybody. I wanted to share a quick video here in the lead up to Alibaba's earnings this Friday. So, for those of you who don't know, Alibaba is my largest portfolio holding. I'm still very constructive on this stock, and in this video, I want to lay out exactly what makes me so excited going into earnings and why I believe we are just getting started here. Okay. So remember that I started buying shares of Alibaba about 3 years ago, give or take, 2 to 3 years ago. And as you can see, so this is the portfolio from Interactive Brokers, and you can see that I started accumulating shares at about $100 per share, give or take. But then I continued to buy as the stock continued to show weakness. All right, so I brought my average cost per share to about 75, and now, well, it's been a double ever since, more rough cut, and I do expect to see further strength going forward, and I'm not taking any profits off the table until it hits my target. All right, so what I want to explain here is what makes me feel so excited, what led me to start a position in Alibaba about 2 to 3 years ago, and why I still think there is upside, even though I've already doubled my position. And for transparency, you can see so far the portfolio has achieved a 43% rate of return. We started the portfolio in January 2024, which equates to a 26% annualized return so far. So if we continue at this pace, this means that we are on track to double our money every 2.8 years. I'm not sure whether this is sustainable over the long term, but I'm more than happy with the 15% average return, because that means I'm doubling wealth every 4.8 years. So these are some. So what caused me to buy Alibaba at the time? So about 3 years ago, for those of you who don't know, there were many clashes, right, between the United States and China. And that coincided with the Chinese government crackdown. That coincided with China's government crackdown on big tech firms. And so Alibaba, of course, was the crown jewel of tech. And so it was at the forefront of those hefty regulations and some penalties. And of course, we know that in China, unlike Western countries, the government plays a strong hand in the economy. And so sure enough, all that negativity resulted in an exodus of capital away from China. And sure enough, the stock collapsed from $312 per share to about 50. What was the low? The low was about $66 per share. So this was nasty, and part of that was because as a result of that government intervention, Baba lost some competitive edge. Okay, because it's like they really penetrated the moat. Okay, so one of the things that Alibaba will do is they will lock their customers into their platforms, right? And they wouldn't allow them out. Well, they could if they wanted, but there would be consequences. And the government just forbade that. And so, well, yeah, that's one of the reasons why they started losing some market share, and part of the reason why the competitive landscape became fiercer in the tech industry. Okay, but fast forward 3 to 4 years, and I still think the situation it has improved a lot. So the government has backed away. Okay, so the regulations have already been implemented, and companies are getting used to them. And profitability. Then, of course, came the advent of AI, and sure enough, Alibaba has been at the forefront of innovation, and they have been implementing AI solutions across their business segments, which is increasing both revenues and margins and also profitability. Okay, so what makes me feel so excited? Okay, so let's talk. I just condensed the main details into a few points that you can see right here. And these are some of the highlights. Okay, so look at this. And I'm not making this up. You can do your own due diligence. Once again, nothing that is shared here is financial advice. consult your own financial advisor. This is just for educational purposes, but this data is correct. So they are the e-commerce. They are the leading e-commerce player in China. You can see that Taobao and Tmall still dominate China's e-commerce landscape. They have about 51% market share. Okay, and look at that. Not only are they number one e-commerce player in China, but they also are the number one cloud service provider in China. So they have the cloud market leadership with about 33% market share. Yeah, and what's interesting and what makes me very excited as well is that many startup companies that are in the AI space, they essentially have taken a position in those companies. Okay, so it's like they go to them and they say, "Hey, you wanna make use of our leading cloud infrastructure? That's okay. I will do that for you in return of equity," which which of course places them in a very favorable position if some of those startups do go on to deliver substantial returns over time. And I do believe that's going to be the case because China is the world's second largest economy, and they are very competitive in the AI space. And so, yeah, I do believe that's going to be the case. So they have taken stakes in pretty much every AI startup in China. Of course, I'm exaggerating here a bit, but still, many startups do have. So Baba gives them cloud infrastructure in return of those, in return of equity, essentially. And none of this is factored into the stock price, as I will share later on. But okay, so another thing that is very interesting, and if you've been attentive, you will see that over the last 7 quarters, 6-7 quarters, Alibaba's AI-related cloud products have posted triple-digit year-over-year growth. So it just doesn't stop growing. And as they continue to grow, you're going to start seeing these AI-related products, right? So they will contribute more and more to revenue growth over time and also profitability. So massive AI investments. The same way the biggest Western names have been the biggest. So the most competitive companies in the AI landscape, the same way they've been allocating billions of dollars towards AI investments. Alibaba has also committed over 52 to 53 billion to AI and cloud infrastructure over the next 3 years. And let me go here. This is Stock and Lock, which is one of the platforms that I use for stock research and analysis. And you can see that CapEx spending has been increasing substantially over the last few years. Let me switch this to over here. And if I go here to cash flows, you can see that CapEx, let's see, depreciation, where are my cash flows? So you can see that investments in plants, property, and equipment have been exploding. Of course, that makes a lot of sense because cloud infrastructure will require a lot of physical assets. And this is expected from a company that wants to stay competitive. Okay, and for them to continue to deliver on AI and to stay competitive, especially in a in a fierce industry, it means they're going to have to reinvest a lot of the profits that they earn back into the business, and so it makes sense for the capex to be increasing. What I really don't like about that, at least over the short to medium term, is that all that capex is not going to immediately translate into higher profitability. So profitability will likely take a hit. In fact, Alibaba suffered that hit, has been suffering that hit over the last 2 to 3 years, ever since they started reinvesting a lot into growth. But the thesis here is that over time, we should expect that capex we should expect those investments to pay off handsomely. All right. So that, which is very good. And if I go here to the balance sheet, well, let me check the margins actually. And you can see that easily. Look at that gross margin. So gross margins have come down to a low that we saw back in 2022, but now they are once again upticking, which is good, right? Because revenues are accelerating. And you can see that operating margin is also on the way up. It hit a low of 11.20%, but it's now upticking. So margins are improving, which is very important when it comes to a turnaround, right? Look at net margin. Net margin, same story. So it hit a low of 7.26%, but now we are already at 13%. And I do expect this to continue as I mentioned, revenues are continue to improve, and profitability continues to improve as well. Okay, but interestingly enough, let me continue here. In addition to all of that I just mentioned, what is so cool is that I strongly believe they are still the cheapest AI player in the world. Okay, they have I already mentioned that stakes that they have in pretty much every AI startup in China. And they've got the fastest large language models in their Quen offerings. They've shown to be very fast as well, and they kill many other offerings provided by leading Western companies. Like for example, they compete with ChatGPT, and you can see what's interesting from a valuation standpoint is, look at this. They are expected to grow earnings by 20% next year. So if I show you this here, if I go here to Alibaba, to Yahoo Finance, you can see that analysts are estimating 20% growth next year, and yet the PE of this company is 16 times earnings. So this implies a PEG ratio of below 1, which indicates that the company is very cheap based on projected earnings growth. Okay, and you can look at every metric that you can, every metric that exists, and you will see that, with the exception of the price to free cash flow, which currently sits at 27, because free cash flows have taken a hit on the back of all capex spending, of course. So this is an outlier. I wouldn't pay too much attention to that. But you can see, for example, the price to earnings sits at 16, price to sales at 2 times. The earnings yield is very high as well. And this is a company that you have a net cash position. Okay. Very, very, very bullish. Look at their margins as well. Pretty good. And in terms of capex, like I said, I typically don't like capital intensive industries. So for example, capex as a percentage of revenue sits at 4%. That's okay. I think a number before 5 is okay. But capex as if you do so capex with relation to operational cash flow, you can see that currently sits at 25%. Ideally, I want to see this below 15. Okay, but unfortunately, because of the heavy spending, a higher portion of the operating cash flows is going towards capex investments. So, but we have to assume that those investments again are going to translate into profits down the line, and we are already seeing that. Okay, so I said the same thing about 2 years ago, that the capex that they were committing at the time should translate into higher profitability, and sure enough, margins have been improving. Now, the main reason, one of the main reasons many investors flew China was because of the real estate, the 2008 type of financial crisis that they faced about 3 years ago with the collapse of Evergrande, right? So they had the real estate bubble, and as a result of that, many unemployment. Okay, it really hit the country hard. Because many Chinese have a big chunk of their wealth tied into the property markets, unlike many Western nations. And so, of course, the result of that is that consumers started to curtail spending, And Baba, being first and foremost an e-commerce company, got hit quite hard, okay, because the consumers really pulled back spending. But sure enough, we are seeing the turn of the tide, and I do expect that going forward, as the consumer becomes more confident, because they have a much higher savings rate compared to Western nations, they will start buying more stuff. And of course, this is guaranteed to hit the to this will reflect in Baba's bottom line. Okay, so net income. So this is what I wanted to share with you, and I think so. Again, they are reporting earnings on Friday. They are my largest holding right now. Another thing that I wanted to share with you is, let's talk a bit about the intrinsic value of this company. And for those of you who don't know, I use valuation. I use three methods for determining the value of a company, and these are based on Phil Town's rule number one workshop that I attended about 5 years ago. It was very insightful. So if you haven't yet, I strongly recommend attending if you are interested in investing. And based on my very conservative assumptions, you can see that all these three models, by the way, the margin of safety, the 10 cap rate, and the payback time, they already have a 50% margin of safety built in the model. And you can see that the margin of safety price is around 112, 80, and 70. So if you do earnings, that's actually 190, which means you could pay anywhere between 80 and $120 per share, and I think you will be fine because you have a 50% margin of safety included. So this means, in other words, there is still time with the stock currently trading at about $123 per share. I still think you have a significant margin of safety because, per my calculations, the intrinsic value should sit at around 200, anywhere between $250 and $200 per share. And I'm not banking profits until we get there. I'm not sure if we're going to get there over the next few weeks or so. In fact, I don't expect that to happen, but I do expect this trend to resume upwards. And the Friday's earnings and conference call, the guidance that management will provide can really set the stage for that to happen. Okay, so look, very exciting times indeed. Stay tuned. After they report earnings, I will release another video with the main takeaways from the earnings report in the conference call, and let's continue to make money.